Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. So nice to see the different investors from around the world here at our group. And we are going to go through an interesting topic today. We're going to talk about currency trading, and we're going to look at some examples. The example that I always love to use with currency trading is one of the most profitable trades in history. It was made by George Soros in the year 1992. When he actually managed to get a trade in that generated a $1 billion profit against the Bank of England. So we'll go ahead and show how that went down. I'm going to speed this up to double time.
George Soros, a man shrouded in political controversy, and yet one of the most successful investors of all.
Pursuit of low inflation by market problems or political pressure. I was under no illusions when I took Britain into the exchange rate mechanism. I said at the time that membership was no soft option. The soft option, the devaluers option, the inflationary option, in my judgment, that would be a betrayal of our future at this moment. And I tell you categorically, that is not the government's policy.
But while November 1990 might have been the start of a very successful political career for John Major, it was just the beginning of Britain's economic problems. You see, when the UK joined the ERM, it was already in a recession. Now, when an economy is in a recession, the central bank, in this case the Bank of England, wants to cut interest rates to prop things up. But because of the ERM, it could no longer do that. The British pound was already a very weak currency, with the UK's inflation rate being 3 times higher than Germany's. If the Bank of England cut rates, it would help the British economy, but it would devalue the pound so much that Britain would have to leave the ERM, which of course John Major would never allow. And so, between 1990 and 1992, the British economy suffered. Of course, just keeping interest rates high wasn't enough to maintain the pound's value. And so throughout these 2 years, the Bank of England would frequently go to the market and start buying up pounds by the millions, using up its foreign exchange reserves in the process. Even that didn't really help, though, since the pound continuously weakened during this time, just barely within the limits of the ERM. Pretty much every currency speculator understood that eventually the British pound would have to devalue. But the billion-dollar question was, when would that happen? The man with the answer was George Soros. He had been running his hedge fund since the 1970s. His specialty was predicting and sometimes forcing the capitalists to big market events. He knew that almost everyone was ready to bet against the British pound if only there was some sort of bad news that could trigger a stampede big enough to overwhelm the Bank of England. Starting in August 1992, Soros and his fund began building a position against the pound. And here's how he did it. He'd go to a big bank or another hedge fund and he'd borrow pounds from them with the promise of repaying them with some interest on top. Then he'd go to the foreign exchange market and he'd sell those pounds to buy German marks instead. The idea being that when the exchange rate drops, he'd be able to buy back those pounds cheaper, earning the difference as a profit. By the end of August, Soros had slowly built up a position equivalent to $1.5 billion against the pound, but the exchange rate had barely moved. He needed some sort of news to really start increasing his position. And luckily for him, on September 16th, the president of the Bundesbank held a seemingly innocent interview that Soros could nevertheless use. The Bundesbank president said that he doesn't rule out that some currencies might come under pressure, which in and of itself is a very vague and unconvincing statement, but Soros decided that it was good enough for him. That same night, while Europe was asleep, Soros called up any international bank or company, or really anyone that had British pounds, and he tried to borrow them with great success. By the time the British woke up, Soros had sold the equivalent of $10 billion worth of pounds on the open market. Unsurprisingly, the Bank of England was in complete chaos. After an emergency meeting with John Major, the Chancellor of the Exchequer began a desperate fight. At 8:40 a.m. on September 17th, he authorized the purchase of £1 billion from the market to no effect. By 9 a.m., he had purchased another £2 billion, at which point he dialed John Major again to request permission to increase the interest rate, which of course, because Britain was in a recession, would be devastating to the economy. Initially, John Major refused because he thought it would be political suicide. But as Soros and the global currency market continued selling pounds, by 11 a.m., Major conceded, and Britain made a surprise announcement that it was increasing its interest rate by 2%, which is a very big increase. By the end of the day, Britain had purchased £27 billion and had increased its interest rate a second time to 15%. But just Soros alone had sold about half as many pounds, and by that point, the entire world was following suit. At 7:30 p.m., the British government accepted defeat with the following news conference.
A unique day in London's financial markets ended with the Chancellor announcing that the pound was being suspended from the ERM and that the second of 2 dramatic interest rate rises during the day was after all cancelled.
Today has been an extremely difficult and turbulent day. Massive speculative flows continue to disrupt the functioning exchange rate mechanism. As chairman of the Council of European Finance Ministers, I've called a meeting of the Monetary Committee in Brussels urgently tonight to consider how stability can be restored to foreign exchange markets. In the meantime, the government has concluded that Britain's best interest served by suspending our membership of the exchange rate mechanism.
Over the next few days, as the foreign exchange markets were left to their own devices, the British pound fell by 15% against the German mark and by 25% against the US dollar. Soros and his fund pocketed a nice $1 billion from their trade, while the estimated cost to the British taxpayer was over £3 billion. Here's the funny thing, though. In the aftermath of Black Wednesday, as they called it, the Bank of England was once again free to control the British pound, which it did, and over the next few years it steadily cut interest rates and actually restored the British economy to high levels of growth. By 1997, the British pound was actually more valuable than it had been during the ERM, and the UK was on its way to 16 consecutive years of economic expansion. So much so that some people actually call that day White Wednesday. So in the end, Soros might have actually done the British a favor, even though he pocketed about $15 for every man, woman, and child in Great Britain. Now, if you enjoy learning about financial markets, then you'll be happy to know that I have 2 animated courses on Skillshare about how the stock market works.
So this is actually quite an interesting situation here.
George Soros, a man shrouded in political.
With Soros and all of how that went down, because it's one of the most profitable trades in history. And there's certain elements in that trade that if we look at what's going on in the world today, there's some similarities. And I look forward to showing that. Okay, so basically with exchange rates, if you're new to predicting exchange rates, the easiest way to predict exchange rates, if you're not experienced in this, is to just use the rule of good economy, bad economy, and you can predict what's going to happen. So if you're looking at two countries and you're trying to figure out what's going to happen with the exchange rate, what you can do is just ask yourself, is that good or is that bad? So, for example, anything that is an indicator in a bad economy, that will cause the exchange rate to lose value. So, for example, if we look at the situation with the Russian ruble versus, say, the US dollar, right now, the sanctions that have been put in place on Russia, they have caused the net exports that are goods and services, Russian goods and services that are being sold abroad. They are not selling as many goods and services due to the sanctions. That causes a decrease in the demand for the ruble, and that puts downward pressure. It makes the ruble depreciate in value. Whereas if an economy is doing well, if an economy is putting more goods and services into the market, they will have more demand. If a country starts to export a lot more goods and services, that will mean more people are buying those goods and services. And to buy those goods and services, they are exchanging out of their currency and they're purchasing the currency of the country that is doing well. But it's actually a nice, simple rule if you're ever trying to figure out what's going to happen. So let's take a few examples here to try to predict what would happen. So let's imagine that the US interest rates are going to increase, but the UK interest rates are not going to change. They're going to stay the same. All other factors are constant in this example. Well, if the interest rate increases, it increases the demand for that particular currency, and it makes that currency strengthen. So if the US interest rates were to increase and the UK interest rates were not to change, in that case, there would be more demand from savers as they want to move their money into US dollars so that they can earn a higher return on interest rates. And that causes an increase in the demand for the currency, which strengthens the currency. And we're going to look at something that happened here with the Russian central bank, what their central bank did, where they increased the interest rate a tremendous amount. They increased it up to 12%. They raised it by a total of 350 basis points recently. But let's first look at this just to go over the idea so that it's clear. Basically, these things they are one factor. They're not the entire factor, but they're one of many factors that drive the exchange rate. So another example, good economy, bad economy. Let's say a country goes and gets itself in a lot of debt. And let's say you compare it to another country that is not running a lot of foreign exchange debt. In that case, the country that has a lot of debt, you could try to figure out, well, which currency is going to appreciate? Well, running your economy into a large amount of debt is not going to help your currency. And there's some African countries that just love to run their exchange rates out of control. So these are things that you can use to kind of predict what's going to happen. If a country starts to export more, that is good for that country's exchange rate. It's going to strengthen the exchange rate. So basically anything that increases the demand for a currency, if you have more demand for the currency, the exchange rate increases. If you have more confidence, if people feel confident about a country that nothing bad is going to happen, it causes its currency to increase. Now, here is a great graphic, and I want to go over this because it's actually quite interesting. We're looking at some real world data here. This is for Russia. We are looking at what is going on here, and we're looking at the trend. So we see if we go to February 24th of 2022, this line, that's when Russia invaded Ukraine. And we're looking at basically the exports. And this trend before was upward, where the trend is upward. There's more exports. Russia is exporting more goods and services into the market. So before the war, Russia was exporting more goods and services. And even immediately after the war started, Russia continued exporting more goods and services. But over the months, there were more and more sanctions that were placed on Russia. More and more countries said, we're not going to buy your goods and services. And this had an impact where it started to change the direction here. And you can see it where the net exports, where the exports are declining in value, where there are less Russian goods and services that are being exported. And as a result of that, what it does is it makes the Russian ruble lose value because Russia's selling less goods and services into the market. And when they sell less goods and services into the market, there are fewer people that are exchanging their currency for Russian rubles because they don't want Russian rubles. They're not buying Russian goods and services, so they're going to buy something else. So this is an interesting chart, but we talked earlier about how central banks, they will try to stop a currency by doing different, they'll try to make a currency move in a direction. And we looked at the example there with George Soros. If we go back to the exchange rate mechanism in the 1990s, where the UK was in a situation where their currency was under essentially a speculative attack, where people thought that the exchange rate mechanism was wrong and people were doing all of this. Well, the central bank at that time, they increased the interest rates, and they increased the interest rates in the 1990s when all of this was going on with George Soros to 12% on the central bank rate. And now look at this. This is so interesting. We can see here the Russian central bank. They actually, they realized, hey, you know, our rubles are losing more and more value. We are losing a lot of value. We need to get more people to save money in Russian banks. How can we do that? And they said, well, you know, we can increase the interest rate that we pay. So they increased the interest rate by 350 basis points. That's 3.5 points. And that raised the interest rate to 12%. But we look here at this chart and we see that what we're looking at is the trend is this is showing the trend where the ruble is losing value against the US dollar, losing value against the US dollar. The dollar's getting stronger, the ruble's losing value, because we see here, for example, at the peak, it was like 102 Russian rubles. $1 US would buy 102 Russian rubles. And then the Russian central bank, they went and increased their interest rate to 12%. When they increased the interest rate to 12%, it had the effect of strengthening the Russian ruble, where it increased demand for the ruble. And this is an interesting thing, because you can see here how once they made, this is actually showing the exact, it was done on August 15th, approximately, when they did this. So you can see right here, as soon as the central bank did that, the exchange rate strengthened, where the ruble got stronger. But one interesting thing is, once a country raises its interest rates, this has all sorts of bad effects in the economy. So normally, the higher the interest rates are, this is correlated directly with higher unemployment. But we don't see a lot of high unemployment in Russia at this time. And the reason for that is basically so many people have fled Russia, where you've got hundreds of thousands of people that have left Russia, that you do not see the typical, unemployment situation as much, because they have a very low rate of unemployment. It's because they've lost so many people. New people are taking those jobs. But there's other things that are factors here. But it's just interesting to look at that, because right now, if that intervention wasn't done, the exchange rate would have kept going in that direction. And it's an interesting thing. So it's being artificially held there. Here we look at the bond yield. This is a 10-year Russian bond. And we look at the pattern here where the yield is increasing. Well, when the yield increases on a bond, that means that the price of the bond is decreasing, because it's inversely correlated. So we see here on August 15th, this is the date that is highlighted. This is showing when the Russian central bank increased the rates. And you can see that the yield was increasing. And when a yield goes really high on a bond, that is bad for the bondholders because they are losing money. Because now when they want to escape, when they want to sell that bond, they're going to have to sell it at a loss. So it's quite a situation there. I want to go back to the Bretton Woods agreement. This is something that is interesting as well, to look at the long-term history of exchange rates. A lot of people, they look at short-term history where they may be thinking about, oh, what's going to happen in a month? What's going to happen? I present here the British pound US dollar exchange rate over many years. So we start back when Bretton Woods was first implemented towards the end of World War II, when this agreement was put in place in July of 1944, with countries trying to restructure after World War II. And at that time, 1 British pound sterling would buy $4 American. And if you went to 1967, the pound had lost a lot of value. 1 British pound sterling would only buy $2.40. And if you went all the way to the 1st of January 2023, 1 British pound would only buy $1.20 American. So the pound, it has lost a tremendous amount of value. And that is really something, because I talk to guys sometimes in the UK and they tell me, oh, well, you know, I can invest and I can get 8% in the UK. What difference does it make if I can get 8% in the US? And that is something to consider, because if you're the currency that you're investing in, it is getting a certain percentage rate of return, and you can get another rate of return that's an equal rate of return in another country. You have to look at the actual currency to get a sense of what's actually going on there. And one of the most important things with the dollar is that when Bretton Woods finally was put in place, it was designed to prevent countries from supposedly having an unfair trade advantage. But in 1971, they got rid of it in the United States. And when they got rid of it in the United States in 1971, the dollar was removed from the gold standard. You know, the US dollar was originally on the gold standard. And at that time, it was estimated that the true market price for gold was $103 per ounce of gold. But before the collapse of Bretton Woods, the rate that was quoted in the United States was $35 per ounce. And the French central bank actually made out like a bandit on this, where they were able to get a tremendous amount of gold out of the United States by executing that agreement. So it's kind of an interesting situation. And here is a great chart. This shows in the United States inflation. We are looking at inflation in the United States, and we can see that, you know, from 1775 all the way up to about 1970, yeah, there was inflation. It went up and down. But boy, look what happened in 1971 when they cut the dollar off of the gold standard. The inflation just went through the roof. And I've got here some interesting examples. Back in 1971, you could buy a house for $25,000 in the United States. And, you know, it's not so easy to do that now. You could buy, you know, eggs at 45 cents a dozen. So really something there in terms of the exchange rate, how that's all impacted that. But it's definitely something that's important to kind of have an understanding of how all of it works and to look at it. And it's interesting as well to look at these factors that drive exchange rates, because it's not just one factor, it's all of them. But of course, you know, if a country gets out of control with printing money, you can have a situation like the Zimbabwean dollar, where, you know, you can buy 3 eggs for 100 billion. So the way that these charts, I'll leave with you all, you can look at them in more detail, but basically interest rate, it has an effect of improving it increases the demand for the currency if the interest rate's raised, and that makes the currency appreciate in value. And then we've got, you know, several different charts. You can have a fixed exchange rate where the government steps in and artificially fixes an exchange rate, also something that can happen. You'll hear some terms like point and spread. This is something that if you're on a currency that is a well-traded currency like the euro dollar, that has a very low spread. But if you were to pick a more exotic currency, like say the Ukrainian hryvnia and maybe the some other country that's not, maybe you pick another country like say you pick a country like the Zimbabwean dollar, that'll have a huge spread compared to what you would see on a major trading pair. So that's something also to consider. These charts you could just look at. I've got a few reminders. Please fill out the sign-in sheet. If your name's not on the list, please add it and put your information in, because that way you can get a copy of this. And we also have some positive news. We have a new Discord server. We have a new Discord server that is available. We've got a new Discord server that's available. And the link to it is there. So that is where you can sign up to the Discord server and do all of that. So that is some good news there. And then we've got also, if you're watching this on the internet and you're interested in learning more, if you'd like to work with me directly, I do offer mentoring. And then we've got, that is it for our presentation. I'm going to go ahead and stop the recording, and then I'll take any questions that anyone may have.